The team that I work with, we view quality as a spectrum. We think quality can strengthen or weaken over time. We certainly don't view quality as a binary judgment on a company. If I reflect back to 2017, one business that we had owned for a number of years prior was Jarden, and Jarden wound up getting involved in a transaction where they combined with Newell Rubbermaid, and the new company Newell Brands was a company that we still continued to see fitting what we call our 7 attributes of quality, and Newell fit a number of those. We're all well familiar with the challenge that the internet and with that pricing transparency, particularly in selling consumer goods to customers all around the world, has played a role in hurting certain retail-oriented business models. You may be familiar, Newell is a company that had products, everything from Rossignol skis to camping equipment and even baseball gloves. And what happened was what once used to be a competitive advantage for them, brick and mortar, big box retail, ultimately wound up becoming an Achilles heel because pricing transparency via the internet was causing harm to a certain number of aspects of Newell's business, particularly the business model and their inability to continue to maintain pricing power in the market. That ultimately led to a change in our view of quality of Newell, and through this process, we were able to exit our entire position in Newell back in 2017 in the mid-40s US dollar range before it has subsequently since then moved down into the teens. So that's a good example where this iterative process for us of thinking about quality not just helps us identify good businesses to own, but to stay on top of our view of how a business is performing and alter an investment thesis if we see changes.